Well, good evening, everybody, and welcome back to Long Dong Personal Truck Stop. In this sponsored video, we're going to cover a company that sells food and hot dogs. So if you like a nice, juicy, fat, delicious hot dog, this video may interest you. Now, I said sponsored video. If you want a sponsored video, if you want me to cover a specific topic, if you want me to make a dedicated video solely for you about a certain topic, see the pinned comment below, send me $50, and I'll make the video. So let's dive right into this sponsored video and talk about Portillo's Incorporated, ticker symbol PTLO. I've never heard of this in my entire life, okay? So let's run through the basics, and then we're going to look at their most recent quarterly report to see what this company's all about. So they have a market cap of $456 million, and they are basically almost a penny stock. Basically, if you go, I think it's like 5 and below, you're a penny stock. $456 million market cap with revenue for the past 12 months of $727 million, net income of $30 million, so they're profitable, a PE ratio of 13 trailing, and a forward PE of 20, so maybe implying a little bit of growth there, okay? Now, most analysts have a price target of $12.19. So what does this company do? They own and operate fast casual restaurants in the United States. Never heard of it. The company offers Chicago-style hot dogs and sausages, Italian beef sandwiches, char-grilled burgers, chopped salads, blah, 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 blah. It also operates a food truck under the Beef Bus. The Beef Bus. You want to ride on my Beef Bus, baby? They also provide delivery services through its application and website. Okay, so it's a restaurant company. Okay, and interestingly, they have a food truck, whatever. So the stock price has not done very well. So it appears that they IPO'd roughly right at the top of the clown market. Okay, October 21, 2021. And I suspect the valuation was inflated massively because everything was inflated massively during the clown market. And then everything collapsed. People lost a bunch of money and we all forgot about it because total returns don't matter. But anyway, the stock is down 69% over the maximum lifetime of the stock being listed. Over the past year, it's down 52.77%. Year to date, it's down 35%. 1 month, it's down 21%. Over the past 5 days, it's down 11%. And today, it's down even more. So this stock has basically done nothing but go down, okay? So let's look at some of the financials. Let's see what's going on with the revenue, my revenue. So we see that revenue over time has gone up, okay? That's a good thing. You want revenue to be going up. So revenue in the most recent quarter grew 3.63%. That's basically at the rate of inflation, okay? We're going to dive into the earnings in more detail. So revenue's growing. I mean, roughly the rate of inflation. Margins, what's happening to margins here? Margins are kind of trending down, okay? I wonder if the price of beef, potentially that's impacting their margins. So think about it. They got to buy beef and chicken and pork, and they got to cook it and sell it, okay? And beef prices, I know, at least have gone ballistic. So if they're primarily selling beef products, they might be getting a little hits on their margins there because you can only raise prices so much. So over time, their gross margin has started to deteriorate. Their operating margin has also slowly deteriorated. Now, in the most recent quarter, it went up a little bit, but you can see the trend. It's kind of deteriorating over time. Profit margin actually increasing very, very slightly. And free cash flow margin is trending down. Now, it could be because of they're buying more stores. That's possibly the reason. But you can see that all of their margins, except their profit margin, for whatever reason, maybe tax benefits, something else, I don't know, we'll see. Everything else is contracting. So revenue's growing at the rate of inflation and margins are contracting. Let's look at cash flow over time. Operating cash flow has basically kind of remained stagnant, okay? Maybe you can see a little bit of trend to growth historically. But most recent quarter, it dipped pretty significantly, year over year, 40%. But that could be for any number of reasons. It could have been like front-loaded inventory or maybe a lot of accruals for revenue, but the cash hasn't been received yet. It could be for a number of reasons. But operating cash flow has mostly stayed flat. Capital expenditures over the past couple of years have actually gone up. So it looks like they're investing more property, plant, and equipment, restaurants, et cetera, et cetera. Let's see. What else do we have here? Buying. Oh, look at, isn't that cute? They're buying back stock. They bought $826,000 of stock, $826,000 of stock. That's very cute. Okay, let's go look at the share count over time. Are they diluting, bro? Look at that. Look at that dilution, bro. They're diluting. They're issuing shares. So revenue is growing roughly at the rate of inflation. Margins are contracting, and dilution is going up. But at least I'll give the company, at least they're making money. Okay. Let's look at valuations. Let's see. So PE is basically as low as it's ever been. Forward PE is as low as it's ever been. Price to sales is low as it's ever been. Price to books, can't even read that. Price to operating cash flow, $5. This is definitely a value stock. Okay. You paid $5 for $1 of trailing operating cash flow. That definitely indicates a company that's not growing very quickly. Okay. Let's see. Inventory turnover. So they're actually improving on their metric of inventory turnover. They're improving on their metric of inventory turnover. So they sell 1 unit of inventory every 59 days. I think I got that ratio correct. And overall, not a very high returning company. Okay. It's a freaking food business. Wow. So let's dive straight into the most recent earnings. So I guess we can go look at the food later, but I mean, it looks like I would eat at this place. Looks pretty good. All right. This is the Portillo's Incorporated second quarter 2025 financial results. Total revenue of $188 million, an increase of 3.6%. Same store sales increase of 0.7%. So their same store sales have actually dropped when you factor in inflation. Okay, that's like year over year sales for stores that are generally 13 months or older. So they're actually having a decline in real revenue at stores that they've had open for a decent amount of time. Operating income has contracted to $17.5 million. And net income has increased $1.5 million to a total net income of $10 million. Okay. Let's see. Restaurant level adjusted earnings before interest, taxes, depreciation, and amortization has also decreased slightly by $100,000. Let's see what the team has to say. Our team operated well through a tough traffic environment in the second quarter, managing restaurant level margins effectively and driving solid earnings. I wonder how other restaurants are doing. Probably, I would suspect maybe not too hot. Even Chipotle's having issues, man. Chipotle, the Kang. Even their sales are crap now. We're testing and learning, refining our new market playbook, blah, 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 blah. Okay. So why did revenue increase? Well, the increase in revenues was primarily attributed to the opening of 9 restaurants during the second through fourth quarter. So they're not driving good sales growth at currently owned restaurants. They have to keep expanding in order to drive sales growth. And what that does is that's more expensive from a capital investment perspective. Think about it. If you could have one restaurant and it just grew revenue astronomically forever into the future, you only have to buy one restaurant. But if you have to drive sales by just constantly opening more restaurants, you're spending a lot of money on capital expenditures, which ultimately eats into your margins, both from a cash perspective, because it subtracts from free cash flow, and from a profit perspective, because you have to depreciate any buildings that you own or lease them, which is another expense. Okay. Let's see. Restaurants not in the comparable restaurants base contributed $6.1 million. Wow. So, yeah, it looks like new restaurants only contributed $6.1 million. Let's see. So what's happening with same restaurant sales? It only grew 0.7%. That's a decline in revenue in real terms. The higher average check was driven by an approximate 3.4% increase in certain menu prices, partially offset by 1.3% decrease in product mix. To address inflationary cost pressures, the company increased select menu prices by approximately 1% in April of 2025 and 0.7%. Okay, so inflation's definitely hurting them. Let's see. Operating expenses. Food, beverage, and packaging costs were negatively impacted by a 1.9% increase in commodity prices. Food and beverage is very volatile, or especially food can be very volatile. So you could see huge changes in margins based on food prices. The increase in labor expense was driven by incremental investments to support our team members. What does that mean? Lastly, the increase in other operating expenses was due to the aforementioned restaurant opens and increase in repairs and maintenance, utilities, and insurance expense, partially offset by lower cleaning expenses due to vendor renegotiation. Uh-oh. Somebody's not making as much money. Okay. Let's see. General and admin is up because of higher professional fees. That could be taxes or whatever. And advertising and operating income decreased primarily due to the pressures mentioned above. Okay. So overall, they're not doing too hot. Let's see. Second quarter 2025 developments highlights. No new restaurants were opened during the quarter ended June 29, 2025. Subsequent to June 29th, the company opened one new restaurant in Tomball, Texas, bringing the total restaurant count to 95. Should this company even be public? 95 restaurants? It's basically a penny stock. This is very risky. Which includes one restaurant owned by C&O, of which Portillo owns 50% of the equity. In the second half of 2025, the company plans to open 12 new restaurants. Well, that's the only way they can grow freaking sales. The company's current focus continues to be in the Sun Belt, with plans to continue expanding in Texas, as well as near Atlanta. Additionally, the company plans to open its first inline walk-up restaurant, while simultaneously filling in existing markets, including in Chicagoland and adjacent territories. Wow. All our restaurants are expected to be restaurant of the future. Oh, it's the future, bro. Except one pickup only in our first in-line walk-up restaurant. So let's see what their financial targets are. Unit growth. They are updating their target. Well, there's no change in the target. They're still targeting 12 new restaurants. Same store sales, they're targeting between 1 to 3% growth in revenue. That's basically below inflation. Revenue growth, they massively revised down. Their prior target was 10 to 12%. They've revised it down to 5 to 7%. Commodity inflation between 3 to 5%. So commodity inflation, they're saying, is going to outpace revenue growth or be close to it. The only way they're outpacing commodity inflation is because they're opening new restaurants. The same store sales are lower than the commodity inflation. So they have to keep opening new restaurants just to grow sales, which comes with more capital expenditures. Labor inflation, 3 to 4%. That's growing faster than same store sales. Restaurant margins, they're guiding the same. General and admin, you can see they're cutting expenses a little bit compared to their previous guidance. Adjusted EBITDA growth. They initially guided from 5 to 8%. Now they're saying flat to low single digits. And then capital expenditures, they're maintaining the same guidance of between 97 to 100 million. They're not doing too well. All right. Long-term financial targets. Annual unit growth, 12 to 15%. Just keep opening stores, bro. It's the only way you can drive sales. Same store sales, low single digits. Revenue growth, mid-teens, all driven by capital expenditures. And adjusted EBITDA growth, low teens. Okay. Not doing too hot. Let's look at their balance sheet. What's going on here? All right. So what drives most of their expenses? So food, beverage, and packaging costs are 33.8% of expenses. Labor is 25.7%. Occupancy, 5.3%. Rent. And other operating expenses, 11.6%. So currently, total restaurant operating expenses are 76.4% of revenue, which is an uptick from 75.5%. They're having a hard time growing revenues fast enough to offset costs of labor, commodities, and costs for opening new stores. All right. General and admin expenses are 10% of revenues. That's actually increased a decent amount from the prior. Pre-opening costs, a little bit less. Depreciation, a slight increase, but nothing crazy. Net income attributable to equity method investment. Okay, so it looks like an equity investment is when a company invests in another company but doesn't control it. And how the accounting works is when the company you own records a profit, you pass that profit through to your financial statements. So we can see this net income of 382 million or 382 million was because, or was that 382,000? 382,000. Wow, it's some crazy net income. Was because of a other restaurant that they partially own. So, but that could change at any time. And then other income, we don't know what that is. Is that crypto? Okay, let's look at interest expense. So interest expense has actually gone down. Interest income's up a little bit. Tax receivable agreement liability adjustment. Okay, so their bottom line profit, which we saw a spike in the most recent quarter, a good chunk of that was because of a tax adjustment, it looks like. Interesting. Wow. Tax adjustments, bro. That's what you should rely on. All right. So overall, earnings per share did grow, but this is very concerning. And look at the diluted earnings per share. So this year, or diluted weighted average common shares outstanding, 69, almost 70 million compared to 64 million the prior year. They're popping out shares, baby. Balance sheet, 50 million of liquid assets versus 171 million of current debts. They got some debt coming due. Look at this short-term debt. They're going to have to refinance that. $70 million? Okay. So we'll see what interest rate they can get with that. Long-term debts. They got 240 million of long-term debt. Tax receivable agreement liability. Not 100% sure what that is, but that's $343 million. And an adjustment on their income statement came from this. They adjusted this a little bit, and that gave them a artificial boost to profits. Let's look at their assets. A lot of intangible assets. Goodwill, trade names. Most of their long-term assets are from acquisitions and intangibles. I mean, they're not underwater when it comes to long-term debt versus long-term assets, but they do have a lot of intangible assets on the books. Woo, man, not good. All right, so let's see. So they're reconciling net income to operating cash flow. Depreciation's up a little bit. Loss on sale of assets. Equity-based compensation, deferred income tax expense. Let's see. So the main reasons that cash flow dropped was timing issues for inventories, accounts payable, a timing issue for payment of accounts payable that had a huge swing. And that's basically it. Okay, what do they do with their financing? So they issued about 45 million of short-term debt and paid off 38 million of long-term debt. They borrowed short-term and paid off long-term. Interesting. Let's see. Some dividends, some stock options being exercised. I don't know. What do you guys think about this one? Seems pretty stagnant. Okay, seems like a pretty risky stock. All right, once again, that was a sponsored video. And if you want a sponsored video, see the pinned comment below. Send me $50, $45 if you're a member. And I'll cover a topic about whatever you want, unless it's completely clownish. What's up, soy boy? With used Teslas being so cheap now, are you finally going to invest in one to save it? Absolutely not. Okay, I could spend $20K on a Tesla or whatever, however much it costs, or I could just keep paying gas on my paid-off car. It cost me $30 to fill up my car like every 2 weeks. Yeah. Not buying a Tesla. I never understand why dorks invest in the end product when they can invest in a raw product like Tyson's Foods. Well, I mean, any company can get cooked. Your latest Tesla video is clownish. Thank you. Be a member. Why would he buy one when he already paid off the van? Exactly. I'm done with car payments. I literally just got rid of my car payments. Literally. I literally just paid off my car like 3 days ago. I am not doing car payments. I just had to do a repair on my car. I spent like $400 something. Guess what? I don't care. At least I'm not paying a car payment anymore. I'm so done. All right. I bought more Tesla a few weeks ago when I said I was going to. Everybody laughed. Who's laughing now? I'm laughing. I'm laughing hard. Congrats, bro. I bought pork belly during 2020 and made 20x. 120% return since 2024. That's a lifelong VT return. That's true. You're a genius. You should start a course, bro. Congrats. Probably working a night shift at his gas station job. WTF is this company, by the way? It's a food. I've never heard of it. I mean, I would eat there. It seems pretty good. It's got like hot dogs, you know. It's got some sandwiches. Looks pretty good. Yeah, restaurants are getting cooked, man. Restaurant heading straight into recession. Good luck with that. Portillo's food is average fast. I mean, it seems okay. You know, I'd probably eat there. My average is 45. Uber at all-time high, buying more tomorrow. What, did Uber have earnings or something? McDonald's is 1,000. I would rather eat at Portillo's than McDonald's. McDonald's is very, I call it McLard. McLard ass. It's disgusting. Why are you not a member anymore? Because he's a brokey. I need you to rebellion against strongman. Chipotle is bringing back carne asada to me. That's a sign to buy the stock. Oh, yeah, they try to convince me to have some. They're like, oh, you could have a free sample. Yeah, you could have a free sample of carne asada. And you know what I said? I said, yeah, I'll take your free sample, but I'm sticking to chicken. Yeah. I like my $10.16 burritos. $10.16 for a massive, thick, throbbing burrito. You can't beat that. Clownish ETF. All right. So anyway, someone says, can you do a video on PayPal or Adobe? Do they have, is this like an earnings day? All right. If you want to sponsor video, you got to pay me $50. If you're a member, it's $45. Unless I decide to talk about it, but let's see. Did PayPal do earnings? I don't freaking know. Anyway, if you want to sponsor video, it's $50, $45 for members. Okay. See the pinned comment. And I think that's it for this video. I got some other stuff to do in real life, not YouTube. Do another stock, you clown. We pay you for videos and don't even get one. Oh, boo-hoo. Call a lawyer. Anyway, like, subscribe, consider joining as a member, consider doing sponsored videos, and you guys have a wonderful day. Cheers!